What's up, everyone? In this video, I want to break down some of my trades this week. I want to go over my entries, exits, thought process, and my overall analysis. It's a little over $15,000 profit so far in the first 4 days using a very simple price and volume strategy, which you're going to see in this video. So the first trade I want to talk about was on Monday, December 4th. It was a $7,500 profit. And do not look at the profit aspect to this. The most important thing for every setup is the R multiple, or your risk to reward ratio. I do not recommend going under a 2-to-1 risk to reward ratio because that means your win rate has to be much higher. So for me personally, I shoot for 2-to-1 or better on every single trade. This trade was a 2.8 planned risk to reward, and by the time I sold this full position, I got above and or more than my original risk to reward because I held runners. So the context on the first trade, let's just go over the pre-market plan. You have to understand this to understand why I took this setup. And my main thing was 4581 to 4569 level, which is now represented by this pink box. And you all know I chart the S&P 500 futures, and you could trade SPY or SPX options off of this chart or any type of S&P 500 futures related instrument. So for me, my pink box was my level of interest, and if we can break under this, we don't have any demand until 4552. Now in the intraday commentary tab, this is where I update my thoughts in real time as they are developing of what exactly I'm looking for in the market. If I am a bear, I want to see the S&P 500 reject 4569 and 4581 because we had a rally at the market open. Now this rally on the market open, how I was viewing this was a shorts covering rally on the sell-off. What you normally see after the market aggressively sells off below our key level or below any major level, usually we get a bounce or a rally. Now this rally can be fueled by shorts covering. Now in the market, no rally can sustain on shorts covering alone. For the rally to sustain, you would need new buying or new demand built into the market. What I was seeing was at 9:30 Eastern time when the market opened and rallied higher, this was due to shorts covering. I personally viewed this as a sign of weakness because the market was rejecting my supply zone or key level of sellers. The market was rallying on shorts covering, and if sellers stepped in, I would be interested in taking this thing short, especially how weak I was viewing this auction. So with this in mind, I saw this rally higher. I saw the market break a high of day here at 9:49 Eastern on a 1-minute chart, and I was comfortable with signs of the rally not sustaining, with signs of sellers on the tape, to take it short at 4576 when the market looked just like this, placing my stop loss above, a little bit above the high, above the zone at the 81s. So essentially I was risking about 4.5 points for a 4564 low of day breakdown. Then directly after I entered this setup, the market aggressively sold off, and my target is that green line. I sat in about 20 minutes of consolidation before we dumped down. And what I like doing is instead of selling at my target, if I'm spotting volume coming in, so you can see down here that we have a ton of volume stepping in, I don't like automatically getting out directly as soon as it hits my target. I want to wait for a sign of weakness or a sign that the market may want to bounce up. And because of this, I was able to get 2 more points out of that. And I scaled out 80% on that aggressive sell-off for a nice 14-point gain. And then we kept selling off, and I sold the remainder at 4558. So I got above my original planned risk to reward by holding a quick little 3 more minutes of runners. And that was a good move because the market did eventually rally up. And if I wanted to hold this for a larger move or not follow my plan, this trade would have reversed against me, and that's why it's so important. I cannot stress this enough to only sell at your position if your target hits or your stop loss triggers. Everything else in between is noise. Also, if you're watching this video and you are not following my Instagram, take 2 seconds, click the link in the description below to do so. I post mini recaps like this on a daily basis on here. It's just simply a good resource that you're missing out if you're not following it. Again, the link is in the description below. Okay, now the next day, this is Tuesday. My next setup, you could tell, was sized down to 7 contracts. My planned risk to reward ratio was 3.25 to 1. By the time I sold this position, I got a 2.3 to 1. So I still maintained above my 2 to 1 or better, but I got out reducing my R multiple. It was still a $3,000 profit. If I was with 10 contracts, it would have been much higher than that. However, the basis for this trading setup, going over the pre-market plan on December 5th, again, which was last Tuesday, scenario number 1, I want to buy the dip on the S&P 500 to play it long as we are above this green box at 4552. I would target 4568 first, and then the supply zone at 4585. The issue with this was the market failed to sell off into the demand zone that I was watching. This is how you have to get creative, at least for me. I firmly believe that being creative and solving problems in the market is a very strong skill and a skill of a very successful trader who can solve critical problems and get creative with those problems. So now in the intraday commentary tab, my plan or how I got creative with this was the market had news at 10 o'clock Eastern time. You could tell by this fat green candle over here, and we saw a very strong rally, leaving footprints of strong buyers on that rally. So getting creative in the short term, if the market could pull back into 4567, 4563, if it can hold, become supported, buyers appear, I am interested in taking this long, targeting high of day, and then 4585 supply. Essentially, if the market makes a large move up or down, it's very important to watch the volume and understand what's going on behind the scenes here, because you could obviously see the volume that came in. You can see the very nice fat little green rally candle to the upside. And if you were watching the time and sales, which is a very powerful tool, and if you are a short-term trader like myself, being able to read the tape is a very, very, very important tool to be always watching. You would have saw buyers here at 4567, 4563, which is where this thesis came that I'm watching for this level to hold. Essentially, the market pulls back into this level. It becomes supported, but I did not see valid confirmation to put risk on long here. Yes, it bounced off the level, and yes, a solid entry could have been down here, but in real time, I honestly did not recognize that. I began to recognize it once the market rallied up like this and then pulled back. When I saw that this level is holding, I felt comfortable putting risk on long here on this pullback at 4572, targeting a high a day, so 8-point target to a 13-point target with a little 4-point risk. So guaranteed 2 to 1 or better. The cherry on top for this setup was essentially at 4576, there was a large 1700 lot offer there. Many people were front running this, meaning they were selling the market due to a passive seller on the level 2. My best advice is don't put much emphasis on any resting orders on the level 2 unless they show intention or actual trades transacting on them. People saw this guy at 4576 and said, okay, there's a seller in the market, let me take this short. They were front running that guy. In this current context, especially bouncing off this level, I personally viewed this as a buyer taking the liquidity from everybody who is front running him. It's just a tool of the Titans that they use to get in or out of a larger position. Then about 5 minutes after I entered, the market rallied up, broke the high of day. I scaled out of this position, similar to what I did the day before, only held 2 contracts remaining, adjusted my stop loss higher. So after I sell at my target, which I don't like holding runners at all, but if I were to do so, I like adjusting my stop loss and taking risk off the table. So sold some into the high of daybreak over here, and then held some contracts remaining above, and then got all out at the 4584 level, which was that supply zone. Now on Wednesday, December 6th, the first trade was a break-even trade, and the second trade was a $4,600 profit. Both were technically winners, but let's go over this first trade first. In the first 5 minutes, we saw a very strong, aggressive sell-off down. And similar to the trade with the buyers, if you were watching the time and sales, around 4591, which is this level right here, to about 4594, there were very large selling aggressive activity hitting the bid as the market sold off, which I viewed as a sign of weakness. With this in mind, my thesis was to short a rally or short a pop into 4594. In fact, the more detailed scenario in the intraday commentary tab was if the market could break above 4591, but not above 4595, which is the top of the box, and then back below the bottom of the box, I am interested in shorting this, targeting the demand zone below. Essentially, this is what I was watching. I was watching the market to break above the 91s, but not above the 95s, because if there are large sellers factored into the market, in this example at the 91s to 94s, if there's large sellers there, you would obviously want those sellers to defend that price where they originally were shown or where they were present in the market. In this example, they were present here in the first 5 minutes. So if this level gets tested again, you would want those sellers to defend that general area of price. Now, the issue with me was I was not patient and I was fearful that the market may not rally into this level. I wanted it to come above and then break under it once above. The issue with me was I felt very conservative and I didn't want to miss the move. So what I did was I got short here at the 89s, which is this yellow oval here, placing my stop loss above the 95s, targeting the demand zone below. So it was essentially about a 14 to 17 point drop for a 6-point reward, again above 2 to 1. Now the issue with this was we got the drop that I wanted, but we were holding the previous day high. I don't mark highs or lows. I am just simply aware of them. So we had a previous day high over here. After I got in this thing short, I saw the market sell off down and I was up about 5 or 6 points on this, but it held the previous day high. With this development, I adjusted my stop loss. Now, I got out of this trade for a break-even setup, and there's two ways we can look at this. If I didn't adjust my stop loss, this thing eventually worked out, and I should not have stopped out because we never came above the 95s. But if it was correct to stop out and adjust my stop loss, that is totally fine, because if you remember my original plan, I wanted to see something like this happen. Break above the 91s, then break back below it to take the market short, as long as we are not above 4595, targeting the demand zone below. So that was always the plan. Just my first entry was mistimed, and I protected myself with a break-even type of setup. 1019, when the market looks just like this, same exact thing. I'm following my plan. I took the market short, 4590, targeting a low at daybreak into 4575. And this trade was a $4,600 profit, 3.7 planned risk, 2.1 realized, again, still above 2 to 1. And essentially what happens here is similar to the first trade. This thing immediately worked out. Volume came in. I scaled out along the way on the sell-off below low a day, and then I scaled out the rest at 4580. It was simply a sellers rejecting and then sellers retesting and defending that reject level in this example right here, especially breaking above this high a day and aggressive sell-off down. If anybody watched the tape that day, you're going to know exactly what I mean, because if all you got to do is go back to 9:34, 9:35 Eastern time on December 6th, replay the tape data, and you're going to see the aggressive selling that I'm talking about, and you're going to see the move up and then sell off down. In fact, on my Instagram, again, it's a good resource that, seriously, if you're not following it, you're missing out. I posted just like a clip of exactly what I saw and how I saw it on the tape aspect of it. And then 2 trades on Thursday, and I just want to say something which is very, very frustrating. There's nothing worse than your analysis working out, but you missing the setup or stopping out early and seeing how much profits you could have made if you held on, especially getting out for a break even. This probably is a worse feeling than taking a losing trade and being completely wrong about the analysis. Because today I took a break even trade and then a $175 loss. So, I mean, it's a small loss, but if we were to look at this, these were both winning trades and they were solid ones. So what I was watching today in the pre-market plan, again, these are posted before the market opens up. Every trade that I'm taking and all the levels that I'm going over is not done in hindsight. This is real-time analysis. Scenario number 1 on the S&P was above that 5-2 demand that we talked about before. If we can get above the 67s and 72s, which is this green box right here, I want to play the market long, targeting the 86 supply zone. Now the market opens up. Same thing in the intraday commentary. What I'm watching for is, this is at the opening bell. If we can pull back and be supported at 4572, 4567, I want to play this long. If we could hold that support, targeting the 86 supply zone. So that's my analysis. It was perfect. It was clean. It was a little bit of a lower quality of a setup because we were in the middle of the balance. However, 956, when the market looked just like this, I took it long at the 73s for a 3-point risk, targeting high a day, which was a 7-point reward, and then the 86s, which was a 13-point reward. Sized down because of a lower probability setup with the current market conditions. And then I got out at break even because for about 20 minutes period of time, the market just ping-ponged back and forth. Now, my mistake with this was my stop loss never triggered. I just gave you all that advice to only sell if your stop or target triggers. And I simply did not listen to that. And I paid the price today. I got out at break even. I even said my analysis is not incorrect. I may have just missed time the move, and I don't want to take risk. I was spotting buyers. They are taking too long. Then at 10:06, I re-entered this thing long at the 75s when we started breaking out above. Same plan, same risk. Eventually, this thing pulled back. So here was my entry right above here at the 75, 76s, just like this. We pulled back. My stop loss never triggered. And at the same candle that I stopped out at, the market rallied up, reversed, and hit my target. Nothing more frustrating than being correct, going against your plan, breaking even or losing 2 ticks on this to see it work out and see you could have just got a nice little 15-point gain on yourself. And 15-point gain with 7 contracts is a very nice profit. So always follow your plan. Always exit if your target or your stop loss triggers. Everything else is noise. This was just such a clean setup that I mistimed it and executed poorly, and it sucks. But this has been a very solid week. I view the week so far as a win, even though this one day was technically red on my calendar. But it's still solid statistics, manage my risk, executing well, and trading on the correct side of the market by focusing on the tape and understanding where buyers and sellers are active with minimal risk and the highest opportunity with the highest odds of working out. So I'm going to end the video on that note. Again, if you are new to my channel, I would appreciate you to subscribe, comment any questions, and also you're missing out if you're not following my Instagram. Link is in the description below, but peace.